Welcome to Money on Tap. Money on Tap, your personal finance headquarters, where we bring out the professionals' experience and some fun in what we call three-dimensional investing, utilizing insurance, brokerage, and fee-based planning. That's what we do on this show. We look at all sides of the issues, and we bring a fully independent planning perspective to the table.
Welcome back. You're listening to Money on Tap. You can reach us at 855-226-8551 or info@yourmoneyontap.com. My name is Seth Cressman, joined here once again with Ben Brayshaw and Dan Mickelin. How are you guys doing today?
I'm doing great, Seth. How you doing, Dan?
I'm doing really good. Really good. How about you, Seth?
Ah, beautiful. Never better. Really an interesting show. Yeah, the title of today's show is, Does Your Bank Have a Gambling Problem? If you can guess where we're going with today's show, that is going to be a big part of it. Before we go there, I just want to take 1 minute to thank you. If you're joining us via podcast, we thank you for being here with us today at Money on Tap. And thank you for the subscriptions and the likes and the listens. All that stuff is really huge for us here. We love putting the shows together and the content together on a weekly basis so that we can just have the conversations with you and, raise the temperature of the room a little bit. Our goal here is to, we're going to have fun. We're going to talk about some things that as financial planners we think are really valuable for you in your financial planning present and future to be working through and paying attention to. And also if you're not a part of Brayshaw Financial Group or Money on Top, we just welcome you aboard. Connect with us. We love the opportunity to have these conversations inside this venue and also in many other places as well. So anyways, with that, a lot of fun lined up for us today, guys. I can't wait to get into this show. Let's jump right in. It's time for Money in the News.
And first up there, we got coming to us from The Hustle, written by Juliet Bennett Ryla. Where are the Girl Scout cookies? And this is something I wasn't aware of. I see them kind of around the neighborhood, but apparently, like everything else these days with supply chain issues and shortages of product, Girl Scout cookies have become pretty rare.
This is classic. To think that the Girl Scouts are selling these cookies for $4 to $7 a box, and then that there's such a shortage that people are selling these things online for 4 to 5 times that price is astronomical. I mean, I think they should just jack the price.
Yeah. I mean, I didn't even know there was a range on this. I was happy to find out that I got my box for $5, so I was kind of to the lower end of the price scale. I thought that was good.
I mean, we always buy the charity box because we don't really eat, cookies per se. But, if you guys are looking for a box, I mean.
I had to restrain myself and just get one because I do feel like, you see them out there. I got mine at Market Basket. They're standing out there in the cold, trying to raise some money. So it's hard to pass it up entirely, but, one box is enough.
But, my wife bought the box. I walk by and just say, I support the Boy Scouts. So can't help it.
So if you're walking by the table that they're selling them from there after Kira and the kids go by, I can understand there being a shortage. But I've yet to experience that. It seems like they've always got boxes out there everywhere I go. There's the Girl Scouts, and we're happy to support them because one of those boxes is not lasting more than 5 minutes in your house, so might as well roll back by and grab a few more. But I'm wondering how they're getting this data. Is this a present? Is this right now? If you were to go on to eBay and take a look and see the boxes for $40 a box or something, and where are they buying them for that much?
I don't know. It's just the New York Times. The New York Times came through, but I to think that there's such a shortage. I mean, they produce 200 million cookies. I mean, that's what this article says. 200 million cookies. It's $800 million in revenue. So if you think about that, theoretically, they could be making 4 or 5 times that revenue.
Yeah. I'm surprised by a couple things there, but they've been doing this since 1917. I didn't realize that. That's over 100-year track record of raising money through these cookies. So good for them. They got a pretty good little model there.
Yeah.
Girl Scout cookie arbitrage, folks. This is a new business model if you haven't researched this yet. Up next for us, 84% of recent first-time home sellers have regrets. Here are 4 mistakes to avoid. CNBC, thank you very much, Lori Konish. So a recent Zillow survey found 9 of 10 recent first-time home sellers feel they could have sold their homes for more money if they had done something different. That's a totally different take on seller's remorse. I don't know that I've ever seen a stat quite like this.
I mean, I really think this is more to do with the times than it does, the actual legitimacy of remorse. I mean, you sit down with your real estate agent and you say, hey, how much is my house worth? They look at the 20 houses that just sold and they say, this is what it's worth, and we'll put it on the market, and the market's in a forward movement. We'll just price it a little bit above that and so forth. But the truth is that some houses have, in the last number of years have grown. I mean, they've doubled in times and in certain areas. And, depending, like if you're in Florida, they have I think it's like 700 people a day are moving to Florida. I could be wrong in that statistic, but it's a massive number. And I know that doesn't sound large, but that is a lot of people. And
every day of the year, yeah, sure is. That's a lot.
So, it's some just crazy amount of movement. So I do believe that this exists for a lot of people who are saying, I sold my house. If I just held it 6 more months, there's so many people looking for homes, I would have gotten even more. But now we have competing interest rates, and I think that's gonna settle down a lot of the buyers in the pricing strain.
Yeah, I think that will definitely change the market. But it's interesting, the point you made there about comparing it to what's happening in the marketplace. But that was the number one of the 4 points is of regret here is not having a winning pricing strategy. And what they say is that if as the Zillow analyzes this, if for a house that's priced competitively, and I'm not exactly sure how they define that, but at whatever criteria they're looking at, those go under contract in 31 days, whereas houses that are not competitively priced take up to 74 days or 73 days, it says here, in order to go under contract. So, as a seller, that's a significant difference.
Yeah, and I've talked to different real estate agents, and they've said, listen, if you actually underprice your house, sometimes you get so many bids in a high bid situation, you just, it potentially goes over. But Seth, I'm sure with your wife and what she knows about the real estate market, I'd be curious what you hear.
Yeah, there's exactly what you just said. It's like sometimes the pricing strategy is counterintuitive. It's like, well, why would I list my house below what I think it's worth? Well, if you get a bunch of, ravenous buyers, which you're used to have in the marketplace, just bidding and outbidding and overbidding, and there were some strategies around that to be able to, get a whole lot more than you would have had you just like priced at the top of the market. Yeah. As far as the rest of these things that we've got the other 3 here, which was ignoring curb appeal, bad timing, ignoring repairs. All of those things I just think are just kind of some real estate 101 in terms of a market. When the market's turned, you got to be on top. You got to do different stuff. You have to have a strategy. If your mindset was, in this, couple of years ago where the market was just bringing people with boatloads of cash to the marketplace to, outbuy and outbid the next person, that's just not the game. And that historically is not the real estate deal. You've got to have your ducks in a row. You got to be looking sharp. You got to be prepared. You have to have great representation in this market, people that know how to move through the market and do it to the best of the ability that it can be done.
Yeah, I think, having the right professional working by your side makes all the difference in the world and just about everything you do. So, real estate certainly falls into that category. But one of the things I thought was interesting, and, I've contemplated this, I think everybody buying or selling a house considers these things is, and it was under the ignoring repairs section, that some of the major jobs that you think are lacking that your house needs are not the ones you're going to get kind of the bang for the buck. You're not going to get your return on, kitchens and roofs and those kinds of things. What they recommend specifically is things like landscaping and paint and carpets so that people can help visualize themselves in the house. So it's really the kind of lesser cost, quicker job, dressing it up a little bit for visual purposes that actually motivates buyers a little more.
Yeah, I thought that was surprising too, and it's the advice you usually get.
Yeah. I'm just going to refer back to what Kira would say. People have to be able to visualize themselves in the house. So that means you got to take down all your family photos because that's not what people want to see when they walk into the visualization of their home. And that's hard for some people. And I can't tell you how many times I've heard the professionals come through, give the opinion, and people just do the opposite thing. So in a DIY mindset, in a DIY society, folks, sometimes you're just going to shoot yourself in the foot, and lesson learned.
Absolutely. Next up, we have, you'll never guess the top performing stocks of the last 20 years. It's a great article. It's by William Dahl. This is a Yahoo Finance article. You know, guys, and probably if we ask most of our listeners, you know, what would be the top performing stocks over the last, 20 years, we'd probably get the atypical, Tesla or Apple, and they talk about that here. And if you're a little more savvy, as they mention here, you might mention Altria Group, which is basically the tobacco giant, right? I mean, they've risen their dividend historically since 2002, but actually, it's Monster Beverage Corp. It just absolutely blew my mind reading this article. I mean, it just to think what they have done. This little energy drink company, I say little because they are tiny compared to their onslaught of competitors. They returned 87,560% over the last 20 years.
It's incredible. Just an incredible number. And I went through a little exercise when I saw the headline. I took a couple guesses myself, and there's Apple, Microsoft. Those are the ones I'm thinking. Never in a million. You gave me 1,000 tries, I wouldn't have got to Monster Beverages. There's no doubt about that.
Yeah, I was actually. I had some other thoughts about some energy companies that I was thinking of, but yeah, go ahead.
Yeah, so it's interesting in reading how they're able to do that, and those two things that they point to. And there's lots of numbers around that, but I won't dive deep on that. And it's number one, that they were smaller to start with, right? So they had less of a valuation in 20 years from now or prior to now. So that it was easier for them to grow exponentially. But as well, they have less expense than these other companies. They talk about what Apple has to spend $274 billion a year to produce their product, between research and development and all the things that they do.
Say that again, $274 billion.
Yeah, and they still make money. It's incredible. But, comparatively in the beverage industry, there's not a whole lot of research and development going on, I guess. They kind of find their formula and they stick with it. So that they spend significantly less.
I guess I'm not getting in the phone making business.
Yeah. Well, sorry, Seth.
So many other variables that go into that whole phone idea. Just think about Google coming online with the Pixel, 10 years ago or whatever. Still, or Microsoft and their phone, still not touching what Apple's doing. And those are very, very large, successful companies that you would think would have the smartest people working for them knowing how to break this thing down and get there. And they're not. I mean, you've got too many variables in there. I mean, sometimes the tech just doesn't work, right? You got something that's good and it works and people buy it. Maybe I'm oversimplifying. However, there's a whole lot less going into a soda, a cola, a drink than there is technology. And it's a very liquid market, folks. Help myself.
That was a bad one.
Speaking of the beverages, though, one thing I thought was cool in this article is they talk about Coca-Cola, right, which is a long-running stock that pays a great dividend, has been a good company. But I always kind of wonder why the symbol was KO. The stock symbol is KO.
Knockout.
And I figured it would be CO, right, Coca-Cola. And it's, that says right here from the guys on Wall Street thought it was such a home run, KO for knockout. Yeah. That's what they gave it for a symbol, which I never knew that.
Yeah, I had heard that once before, a long time ago.
Yeah, if you invested $100 in Coca-Cola in 1919, it'd be worth $1.25 million today.
That's a lot of money.
That's a very long time ago. Folks, that's going to do it for us. Money in the News. You're listening to Money on Tap. We are talking about, does your bank have a gambling problem? We'll find out. But before you go, we want to just thank you for wherever you're finding us. We thank you for subscribing and listening and liking and joining us via radio. Hey, there's an invite for you. You can find us in the podcast world. You can follow us all week long and go back to the 250-some Money on Taps that we've done before this one. We're going to take a quick break. We'll be right back.
Ben, how often do we have somebody come into the office and they don't have a financial plan? And how critical is it for us to put the pieces together and make sure that their future, their retirement is a successful experience. We talk about it all the time here at Money on Tap. If that's you, give us a call at 855-226-8551 or info@yourmoneyontap.com. Whether you have 100,000, 500,000, 5 million. Look, folks, we have the right planner for you. Whether it's Ben or myself, Seth Krussman, we're here for you to get the plan together and make sure that that next step is right.
We appreciate you listening to Money on Tap with Ben, Seth, and Dan. You can contact us at 855-226-8551 or email us at info@yourmoneyontap.com. And now, more of this week's program.
Hey, welcome back. You're listening to Money on Tap. You can reach us at 855-226-8551 or info@yourmoneyontap.com. And it is time for us to dive in to Does Your Bank Have a Gambling Problem? That's our show today. This is the news that just exploded across our desks this last week. And if you are not aware of what's been happening, you're about to have some fun with us going through the where, why, how. And also, you know what? We're gonna land the plane here with some solutions or some awareness of what you can be doing or paying attention to protect yourself. And we talk about being a successful investor here. A lot of that has to do with how you invest as well as your mindset. There's all sorts of ways that we invest in our lives, not just our finances. As financial planners, we take a look at all sides of the issues. We're not talking about just your portfolio and how you've done compared to the market last year. We're talking about, insurance. We're talking about brokerage. We're talking about fee-based planning. We're talking about your family and your business and all of those things working together to get to the outcomes that you're looking for. Hey, with that, just take a minute right now. If you're a podcast subscriber or podcaster not yet subscribed, please subscribe. And thank you so much. That helps us out here at Money on Tap. And if you're listening to us via radio, take a minute to go to your favorite podcast venue. If you don't have one yet, just grab your Apple iTunes or your Apple Podcast or your iHeartRadio or Spotify. Those are all great places to go ahead and grab Money on Tap, subscribe, and listen. Raise the temperature in the room. Make it a focus for yourself moving forward to elevate your understanding and the conversations that you're having with the people that you love and care about, and then bring it on home to Money on Tap. We love having that time with you here outside of the podcast and radio show as well. So, folks, yes, it happened again. If you're not sure what in the world is he talking about yet, well, we're getting there. There was this little thing, this SVB, right? Silicon Valley Bank last week that just collapsed, and we're looking at this in some amazement, as well as some different understanding of how some regional banks and Silicon Valley Bank is no small bank. Folks, I'm trying to remember what the stat was. Was it ninth largest bank in the country? Is that what it was?
It was certainly up there.
Yeah.
I mean, thinking about where it is, Silicon Valley, just
it's top 15
so much money.
at least, right? Assets on deposits is kind of what they gauge some of that as. Well, they had a good old fashioned run on the bank, and what Silicon Valley Bank really focuses itself on is venture capitalism and your Silicon Valley businesses. And that's some big money, folks. If you didn't know, that takes big money. It's a big money world in that arena. And so what happens with that is these are very they're high risk investors, right? So much of what happens inside of Silicon Valley and the startups and, the next hot thing or what could be the next hot thing, they pour money into this. And this is just a strategy that's well known in the VC world, is they will line up about 10 different companies or ideas. They'll put these seed capital into these ideas, and they'll basically run them at the wall, is what the expression is. What does that mean? They're just going to run them as hard and as fast as they possibly can. And there's this wall out there, and invisible wall of success or failure. And those that pop through the other side are extremely successful and extremely profitable. And there's about one or two out of 10 that make it. I don't know that that's the exact statistic on this, but that's the kind of numbers that we're talking about. Most of their investments are failing, but those ones that pull through are incredibly profitable. So it's still a very profitable model. But what's happened in this world lately is that we've had the Fed come alongside and do what? They've raised interest rates. So while they've been raising interest rates, what those venture capital firms and tech firms have been experiencing is a loss of capital. So what they've had to do is go back to the bank, SVB, and ask for their money or demand their money, right? We need some of our money. So these companies throughout this very insular ecosystem have gone back to a handful of banks, primarily Silicon Valley Bank, and started to pull their money out. Well, what Silicon Valley Bank has been doing is putting their money into treasuries for a while. And you'd say, oh, that's great, right? They're putting the money on deposit into treasuries, which is a technically safe-ish place to go. But what they had treasuries that were only paying, maybe 1%. Meanwhile, rates are raising. If you take a look at treasuries today, they're, well over 4%, depending on which ones you're buying into, but they're somewhere in that area. So there's a big difference in what a treasury today is versus the treasuries that they've been invested in. So they're at a loss. And you say, well, hey, how can you say that? How can you be at a loss? It's a bond. Well, yes, it's a bond that's guaranteed by the Fed, and that's the treasury. However, you have to wait for those things to mature in order to get your money back out of them. And when everybody's saying, give me my money today, and you're like, well, I've got that money, but it's invested, they're saying that doesn't matter to me. It's my money. Give it to me now. Well, that's what's happened in the Silicon Valley Bank, folks. There's a lot more to it, but that's my little summary to get us going in this direction.
What's really scary is we have this kind of perfect storm, I think, brewing, which, I think with the Fed raising rates, and as you're talking about this, and they're buying treasuries, and, I look at it like this. If, you're buying a $1,000 bond and one day it's paying 4% when you buy a brand new bond, and then, a month later you buy another bond and they're offering it because rates have gone up, it's now paying 5%. No one wants to buy your bond for the $1,000 that you paid paying 4%. They're only willing to pay you less because they can buy something newer and fresher, paying them more money. So they're not going to give you the same rate you paid. And that's just what these banks are dealing with, is this huge increases of the rates, and it's so fast. I mean, it's just been so fast that it's created this very, very complicated scenario. And then, all these banks, they have to have a certain amount of cash on hand deposits in place, and that money is devaluing because they bought these bonds only months ago, and they're worth significantly less on paper, even though they can hold it all the way to maturity. And you have this constant issue. So now they're borrowing more and more money, and it's definitely creating a whirlwind. And I think the thing that is, I'm just looking at news and articles and stuff, and we're going to talk more about this, but this is a problem for all banks. Like, there's not an investment company out there that's not dealing with this. We've been avoiding bonds as much as we possibly can, even in our portfolios, because of this exact reason for years. I mean, rates are so low; it's just a matter of time before. When rates were, bonds were paying 0.5% at one point, and we were like, why would we want to have a bond paying 0.5%, which is, it's like an anchor dragging behind your portfolio. And so people are like, well, it's risk and so forth. It's like, well, all those bonds are going to devalue as time goes on, as new interest rates go up, So this is a real problem in our world, and it's something that we're facing in a much bigger light.
Yeah, and on top of that, there was the Twitter effect in this particular instance, right? So how fast information flies. And what had gone on specifically at SVB is that their bond portfolio, their overall investment portfolio, so not just the bonds, but they'd made some rather risky tech investments as well, but they were down $17 billion there. And they had
in potential losses. I mean,
the present valuation of their otherwise guaranteed investments was off by $17 billion. Right, so that's just a nugget of information that's out there that somebody uncovered. The other thing that was uncovered is that the sum total of their deposits, because the size of each individual account, that exceeded what the FDIC coverage was on each of these accounts, which many of you are probably familiar. For an individual, it's $250,000 per account, and for a married couple, you can get up to $500,000 for multiple accounts. That's going to be insured by the federal government, but they had, when they took the sum total of all of their accounts, they had $150 billion of uninsured deposits out there. So these two facts kind of made it into the Twitter world, and all of a sudden last week, SVB had $42 billion worth of withdrawal requests come in, and they simply didn't have the cash on hand, nor could they borrow enough fast enough to get it out there and cover these. And that's what you call the run on the bank, and that's where you have a complete failure and a federal takeover.
And I think this is where, when the devaluing of these assets, it's just a paper trail, right? I mean, they could hold these bonds, the treasuries, whatever they're purchasing.
It wasn't the treasuries themselves that sunk them. It was the $42 billion worth of withdrawal requests.
Oh, no, of course. But it was based on the fear that, hey, listen, they potentially have a deficit here and they're going to have to borrow more money, which when they're borrowing more money in the overnight rate, which is what banks do to offset their loan and deposit ratios. Trying to make this as simple as possible for our listeners, so it's complicated. But they have to borrow money at night and pay a fee for that to keep the amount of their deposit numbers in line with their loan amount. But as the value of their assets drop, that creates the complication that they have less money on hand.
More to borrow.
And so that was already straining the bank. I mean, to give you an idea, Silicon Valley Bank was either the 16th or the 18th largest bank in the country, which is, depending on the situation you look at and depending on the dynamics, it could be, another different way. But to give you a perspective of this, right? I mean, the next, in competition with them is Citizens Bank, and then there's HSBC, who's listed as number 15, and then State Street, 14. This is not a small bank.
For a regional bank, that's absolutely huge.
It's enormous.
They're the size of major national banks that we're all familiar with.
Yeah, and I think that's what's really scary for a lot of people who are talking about the banking world. We've been talking, and I'm so glad we're doing this. And I am not happy about what happened, but it's kind of a little bit of I told you so to a lot of people that we've worked with over the time. I even had a client call me today who it's a corporation, and they have quite a bit of money, and it's all in one bank. And I've talked to them for years and years about diversification and so forth. And that sounds simple and easy, but it's not that easy when you're a company, right? I mean, you you end up putting a lot of money with one bank or two banks or three banks, but then you get yourself a little overwhelmed. And so there's a lot of that, and we'll tell a little bit why we have that told you so scenario as we go on solutions that we have and ways to mitigate these fears and concerns, because I think that's what's really important for a lot of our listeners. But we're all concerned about these other banks. I mean, they're talking about Credit Suisse having major financial troubles, and regulators are monitoring them left and right. And I think the fallout from this is not done. And the stock market's saying that when you look at the crashing of these stocks.
Yeah, I mean, part of it is that these banks lend to each other, right? And they lend through the federal system. And, when one goes down, you have to start wondering, well, who are they borrowed from? And are they unlikely to be paid? And what's the effect of those balance sheets when you take a look at that? But, a couple other banks have – first off, Silicon Savings Bank, it was the second biggest failure in history. And since then, there's been a couple more. Signature Bank in New York is on the verge of bankruptcy and going under. And Silvergate Crypto Bank, obviously they're in crypto, and that's a whole different bag of tricks there and other issues. But, generally speaking, when this happens in one bank, there's more to follow.
Yeah, and there's just so much to this. I mean, we were thinking about show names, and we were joking around. Go woke, you end up going broke. And but it was crazy to me to think that Silicon Valley Bank, they donated more than $73 million to BLM groups. I mean, you're taking money in, you shouldn't be giving it out. Like your profits should be going back to the investors. Like I think about credit unions and I think about the old savings bank models and these, national banks and all you're not in that business. You're in the business of preserving wealth and assets. Like the $73 million could be doing a lot of good to us taxpayers. I mean, I know they're saying we're not going to pay, but we're going to pay.
Yeah.
We're going to pay. We're going to pay big.
Yeah, and now they've come to examine the fact that their investment committee, the people that made the decisions, in where this bank invested, had virtually no experience in it. And some of their leadership had come from Lehman Brothers, which was one of the biggest failed entities in U.S. history. That caused, one recession essentially on their own. So you just have to wonder and understand when you get so committed in any individual bank, behind the scenes, who's making decisions, what experience do they have, are they even reasonably qualified to do this job? And if you can't find that information or you're not satisfied with what you find, look for an alternative.
I think that's one of the big pieces here. There's going to be fallout, and there's going to be more of it to come. And we're going to hear more of this stuff. And I'm sure this won't be the only conversation on the show that we have about this. But this is the time to take your action to protect yourself. This is the time to figure out, what is the bank I'm working with? How are they handling the money? Who are they investing? I would call their hotlines and ask them, be like, are you making donations to nonprofits? And what are they? Like, what are you doing with the money that you're making? And why are you actually giving that away? We're in a credit crisis and you're doing this. We need to hold these banks accountable, and we need the volume of people in this world to do that.
Now, some of the fallout that we are already experiencing or seeing is primarily within the banking industry. I mean, they really haven't touched on the VC firms and the tech firms and how they're making their way through this crisis. Not every tech firm out there, not every startup is fully flush with cash. A lot of these are people that have careers in the tech industry and have an idea and get some money and they start going. Some of them are relatively small and really hurting right now, trying to figure out how to get their idea to you and continue to stay liquid to be able to continue to do the business that they need to do. But for the most part, the other banks, like for instance, Signature Bank is one of them. That's a pretty well-known bank. Well, it's had some spillover into its depositors and them making big withdrawal requests. Why? Because they actually do quite a bit of business in a very similar model to SVB, and catering to private companies is really where they've been, and cryptocurrency really firms is where they've really focused a lot. Another is the Silvergate Capital, which has almost entirely been crypto focused. Imagine that having some struggles right now. It's not exactly a story that's completely in line here, but there's a handful right now of what we know going on in the banking community where people are really concerned and they're going and they're getting their money out and trying to either diversify themselves or just hold on to it in a different kind of a form for right now to start to see what's going to happen. You're listening to Money on Tap. You can reach us at 855-226-8551 or info@yourmoneyontap.com. We are talking about, does your bank have a gambling problem? Well, as you've heard here, some have. And in the world of VC and tech and investors, those are big money gambles that pay off big. And guess what? When the Fed raises the rate, most of those companies out there start losing money. And where do they go? They go back to the bank for their money. And there is one bank in particular, Silicon Valley Bank, where most of them have done their banking. That now is illiquid, because that run on the bank of $42 billion that they came to the table asking for has now put them into an illiquidity situation. So does this happen every day? No. It is the second largest of any bank failure that we're aware of today. Washington Mutual, if you remember back in 2008, was the largest. And that was, some systemic problems that we were having within the banking world, period, that got us through to 2010 and the Frank Dodd Act, where they did some different things within the banking of regulating the banks, making sure that there was money on hand, deposits on hand, certain ratios had to be met for liquidity and lending, and making sure that lending was still available. That's one of those things that we're talking about today, is what has some of the fallout been, or what can we start to see in the future here? And I think that's one of them that's important to pay attention to, folks, is that the lending capacity on some of these banks, as they're looking at their books and starting to see you, the consumer, come to them and say, I want my money. I want to make sure I have it, not you. there's a part of that might tighten up for other banks in their lendability because they just don't have those deposits on hand to be able to continue to lend. We're already in a higher rate environment, which makes lending tighter. What does that look like for you, the consumer? Well, we don't know yet, but we do expect to see some of this trickle-down effect start to happen. And as consolidated as this situation is within just a few banks, it's going to be very interesting to see what happens next. With that, we want to do a little bit of comparison because not all dollars are at the bank. Not all dollars are in the market. Where are some different places that people put their money to make sure it's secure? The bank isn't going out of business. The company isn't going out of business, folks. We're going to talk about that next. Dan, that's a good spot for you, right?
Yeah, I mean, when you're looking for interest, right, there's a couple places that we all tend to go and kind of think of first, right? Number one being the bank, right? You can get a CD at the bank. It has a rate and a period of time. You agree upon the time commitment, and the bank pays you the rate. Similarly, you can go to the Treasury world, right? So that's like banking with the U.S. government. They'll issue you a bond, that offers a rate over time, and you can collect your interest rate. And at the maturity date of the bond, you get your principal back. And then there's insurance companies who offer annuities, where they'll take in your money, they'll guarantee you a rate, again, over a period of time. You can earn your interest, either monthly or annually, or wait until the end of the commitment is made and cash out entirely at that point. So these are different entities, and they themselves, as we're learning in the banking world, they carry different risks, right? So that judgment call between where's safer to be is something that everybody individually needs to consider. But when you take a step back and you look at the industries overall, something that history can tell us for sure is that banks fail at a much higher rate than do insurance companies.
I think that's really the surprising thing for a lot of people. Like, why aren't we doing more business with insurance companies when they have a lower failure rate by a significant margin? And that's a good question, right? I mean, we've come to know liquidity as our friend, and banks provide the most liquidity. Insurance companies don't. So that's really the complication. So I think when we really break down the difference, when you're actually looking to buy a bond, you're taking on the risk of what the value of that bond is if you need to sell it early, or you're going to wait till you get your principal back. And you make a very conscious decision. When you put your money in the bank, you see it as, this is liquid. Anytime I want that money, they're going to provide that to me. And there's that understanding that exists. I disagree with that type of banking strategy. And I think that banks I think Dodd-Frank should have included more of ties to time periods and liquidity and break that down differently. But insurance companies also have that same issue like bonds. Like, you agree to a time period, and if you want to get out early, you can't sell the annuity, but the insurance company will get you out of it, but it will cost you money. Like, you'll actually lose money on that investment. And that's a very standard thing. But you can buy CD-like annuities that, pay a fixed rate, as you said, Dan, and it could be 3 years, it could be 2 years, it could be 5 years, it could be 10 years. Those are very common instruments. But I think, honestly, over many, many years, annuities have gotten a bad rap because somebody bought an annuity that paid them an income, and when they died, it stopped paying, and so everyone thinks that's an annuity. The word annuity just means guarantee to pay, and any insurance company that's going to guarantee you any sort of payment has to use the word annuity to it. So, but there's these fixed annuities that a lot of people have not given the attention to because interest rates have been so low and they haven't been competitive, just like CDs haven't been competitive. And what's really nice about the fixed annuity world is they're tax deferred for the non-qualified investor. They don't have to pay regular taxes like a CD. And traditionally, the rates on the annuities are much more favorable because the company knows that they can actually hold the investor accountable for a fee to get out early and can pass on more potential return.
I mean, I think for a long time, and we're not going through these phases of wondering about the safety of banks, the comparison gets simpler, and it's like, you're really comparing the rate to the liquidity, right? If you're willing to be in the illiquid investment, you get a better rate. Yeah. If you need liquidity, you're going to get less interest. All right, but the presumption going in most of these conversations is, well, in either way, I'm going with something that's relatively safe, right? Well, now you have to wonder about that. You need to consider when you're looking at a bank, how safe truly is it? And for the most part, I mean, the banks have a great history, but when you're comparing those two options, specifically, the insurance industry, by far and away has been historically safer play. I mean, we're just getting prepared for this. We looked up a list. Since the 1970s, 91 banks valued at $1 billion or more. So that's not every bank. Those are,
just
big
the ones.
banks.
Yeah, those are just the ones over $1 billion.
Yeah, 91 of them have gone bankrupt since the 70s. Comparatively in the insurance world, it is so far, far, far fewer than that. And even less so when you get into the life insurance world, because most of the insurance companies that run into issues and the handful that have gone bankrupt, the first 6 or 8 on the list were property casualty companies that went bankrupt because of natural disasters. If you're insuring homes in Florida or, Louisiana, when the hurricane comes through, you're potentially in some trouble there if you haven't balanced your books right, and that certainly happens. But comparing the two is quite honestly not much of a comparison.
Yeah, and I think that's one of the things, right? So, with insurance companies, well, actually, to start with banks, there's both federal and state regulations when it comes to banks. The insurance companies are actually monitored on the state level, so it sounds a little bit less, oversight. It's probably actually better oversight in some ways, but and they also have the state insurance pools that each one of these insurance companies, if they want to do business in that state, have to pay into the insurance pool. So you have, not only do you have the insurance company, you have the layering of insurance that they basically insure themselves, right? So insurance companies are in the business of insurance, and then they go to other insurance companies and they insure the risks that they're taking on to balance those risks. And then if all of that fails, then you have the state insurance pool. So it's kind of interesting to me because the insurance companies are so labeled with or layered with insurance. That's really why there's less failures in this space, is my understanding of it. And I think, that is supposedly mitigated by the concept of FDIC. Having FDIC insurance on your account, it's $250,000 a person or $500,000 for a couple in one bank, and invariably people get over that number, and they get a little bit it's no big deal. I've always banked here, and they've always been good to me, and so forth. But the next thing you know, they make some bad investments, and the Fed raises rates too quick, and that bank isn't so stable.
And one of the things that's,
you bring up something that just a conversation that was very interesting with the client this last week. We were kind of going through some of the systemic risk right now and where they're at, and they work with a regional bank here, and having a conversation with the banker that he's done business with quite a bit. The banker was really almost hurt because he didn't feel that the industry or the banking industry as a whole really had his back, or really he was safe within the banking system. And, of course, he explained to him it's nothing personal there. It's not you. It's not your bank necessarily. Like this bank, I do business with this bank. It's the system as a whole that I do not trust, that has the capacity to take care of me should something happen. And he does see, it's a great example what's happening right now with SVB. And, we don't know what the other risk is that's out there, primarily because, we don't get a great window into the balance sheet and the underpinnings of what these banks are. We get a comforting feeling by knowing that we've got this FDIC insurance out here, or, it's where we've been forever, or, what, you name it, we get it. But there is a place in time where we need to just go ahead and have a conversation, kind of get the grown-ups in the room now and just let's figure this out.
And I think that's a different part of the risk as well, is that the banking system is so intertwined, right? There's relationships amongst them all, and they're in some form or fashion connected, by common creditors and common debitors. But in the insurance world, each company is kind of a silo unto itself, right? If they're having struggles, then they're much more likely to be bailed out from their peers than to cause trouble for their peers. So I think
right.
there's a little bit of that kind of separate entity effect.
I see like the insurance companies more of a spider web holding each other together. So if one strand breaks, the whole web doesn't go under.
Right.
You have to take the whole web down. So it's a little bit more complicated to, you think about, it's just a little bit more complicated to get that. I guess we got to go to break. I'll let you go, Seth.
Yeah, Ben, I just have a fear of spiders, and so I'm just going to say it's like my grandma's Afghan. That helps me feel a lot more comfortable when we're talking about this subject. Doesn't it you? Folks, we're listening to Money on Tap. You can reach us at 855-226-8551. No, we're getting uncomfortable here talking about bank failure and what to do next because, you know what? There's options. You don't have to be the masses out there doing what everybody else has done before you. We can't wait to jump back into that with you. You can reach us at 855-226-8551 or info@yourmoneyontap.com. We'll be right back.
If you're listening today and, your questions are outside the box of estate planning or financial planning or any number of the pieces that we kind of traditionally talk about, don't forget that Brayshaw Financial offers auto, home, and business insurance. And we have an entire department that handles all of that for you. Give us a call at 855-226-8551 and be happy to take care of those needs for you. Or email us at info@yourmoneyontap.com.
You can reach us at 855-226-8551 or email us at info@yourmoneyontap.com. And now, more Money on Tap with Ben, Seth, and Dan.
You're listening to Money on Tap. You can reach us at 855-226-8551 or info@yourmoneyontap.com. We are talking about, does your bank have a gambling problem? Maybe. I don't know. We are looking at a bank collapse happening. Could there be more? We'll find out probably in the next couple of weeks. Is it systemic risk? Well, that too. We will start to understand a little more as we go on. But what can you do, or what are the things that are investment options for you to take a look at when trying to see what's the landscape here? How can I be safe with my money and still get something back and not have to worry about a bunch of venture capitalists coming and making a run on the bank and not being able to get my money?
Trying to think through the alternatives and kind of the state of rates. We look at some comparisons and similarly looking and sounding and feeling types of products out there. Now, they all have different risks associated with them. We've focused a lot of the show on that. And there's also things like, the time commitment needed to make, potential cost of access, liquidity. So all these things need to be considered because each of them is a little bit different. But if you look at a 1-year CD rate, which is out there, kind of as an average, and there's lots of options that exist. Every bank offers these. But one of them we looked at was paying 4.15%. So that's a very reasonable 1-year rate. And that's in a CD, right? So the risk to you there in terms of getting your money out, presuming the bank remains in business, is that you would pay a penalty associated with some of the interest you've earned. So that's if you need to break the deal before 12 months is complete, that's what it would cost you to exit a bank-style CD. Now, we have CDs that we can offer inside of a brokerage account that pay a significantly higher rate. Right now, there's a whole sample of offerings, but as an average, you're looking at about 5.3%. So more than a point difference there. So that's a considerable difference in the rate you would earn. But these CDs held in the brokerage account, there is some risk to your principal, right? To get out of them, it's not quite so simple, right? You can convert them back to cash, but you have to put them out to bid, right? So they basically enter the competitive market, and you get whatever the best offer is to kind of cash yourself out of there. And then we have Treasury notes. So a 1-year Treasury is at 4.3%. And the other option we've talked about is the multi-year, or in this case, single-year guaranteed annuity is at 4.4%. Tax deferred, though, and there's a difference there. And particularly as we talk about longer durations, you have the ability to get compound interest without paying any taxes on those earnings.
That's a lot of information, Dan, to take all in at once. So you might want to hit rewind on the podcast or go get the podcast after that. I think the thing is just looking at the CDs, the broker CDs versus the standard bank CDs. The bank CDs are just going to take your interest away either the last quarter or the last year or whatever your contract says basically in that. In the brokerage CDs, you're not giving up the interest you've received. You're just putting it out to bid. So someone's still a competitive interest rate. Someone's probably going to offer you close to what you put into it. Now, if interest rates go down, they'll probably offer you more than what you put into it. And if interest rates go up, they'll probably offer you less. And that's just compared to something else being offered. But there's a big conversation around banking and banking risk and how to evaluate banking risk. One of the ways I look at banking risk is literally by the CD rate that they're offering you. people come in and be like, oh, Dan, I found a CD offering me 4.8%, so much better than the CD that you know of 4.15%. People have this very, wonderful CD rates. Banks who are financially very solvent and very strong don't have to go out and seek people's business. These tantalizing offers of CDs are usually one of the first signs that a bank has a problem with their deposits or their balance sheet. They need to bring in more cash quicker, so they offer a higher yield to investors to be attractive. That's what they're doing. They say, hey, listen, we want more deposits, and we'll pay you more than everyone else is because we want those deposits so bad. And so, bragging about your great CD rate may not be something you want to brag about when that bank goes under. That's kind of the conversation that you want to be careful of, So, but if you're willing to put that money away for a period of time and so forth, then, you're probably also prepared for, the time period it's going to cause to go through the FDIC claim process to get that money back. That's really the outcome of that.
Yeah, I mean, if you're looking for checking and savings abilities, right, liquidity, instant access to money, that's what banks are for. There's nobody else can come close to matching that, right? But if you have an asset that you want to be conservative with, but you don't think you need for 2, 3, 4, 5 years, right? That's when you have to kind of broaden the scope of possibilities and entertain things like a deferred annuity with a multi-year guarantee associated with it. Because for a 5-year investment, there was annuities out there paying over 5.5%. And that's important for two reasons, right? Number one is that's a great rate, and you're going to trade off liquidity, but you can set it aside. Is in the CD world and the Treasury world, nobody expects interest rates, and who knows if this will be true, but nobody's expecting interest rates to stay this high for a 5-year period of time. So in years 3, 4, and 5 of that CD investment, if you just keep rolling your CDs over, you're at this point likely to get less than that 5.5% for sure.
Yeah, and I think that's that's something to evaluate, is when to kind of hit the top. I mean, one of the things here I was looking at, Dan, is you can get a 10-year fixed annuity paying 5.45%, as you mentioned. Your 20-year fixed annuity is 4.65, almost 1% lower for a longer time.
The 5 and the 10 years exactly the same, and the 20 is less.
Yeah, and the 7-year is actually higher. So I don't know what between 5 and 10 makes 7 better, but it's an interesting conversation as you're really trying to figure out, where do I put my money today? But for a lot of people, cash is what they need, like especially corporations. One of the things that makes us unique is we work with one of the largest clearinghouses in the world. It's actually the largest clearinghouse, Pershing, owned by Bank of New York Mellon. Now, our clearinghouse actually layers banks for FDIC coverage, up to 10 banks. And so we're an average Joe might go to a bank and get $250,000 worth of FDIC coverage on an account. We can actually get 10 times that FDIC coverage. We layer banks. So we can get $2.5 million for an individual or even a corporation. And for a husband and wife, we can get $5 million of FDIC coverage. And so what we do is it's not super complicated, but we find out which banks you're currently banking with, and we layer your account with an additional other 10 banks. And that way you're not dealing with lots of different accounts potentially across the board. For some of our business owners who need to have cash, we connect these things with ACH drafting abilities, so we can literally funnel money back and forth overnight if we need to, and the client needs money. It's super great. You keep your $250, whatever you want at your local bank or a couple local banks, and then you put your excess cash in our brokerage program, and we just slide it over. And that doesn't cost anything. It's a free service to the brokerage platform.
10 times the insured coverage. That's incredible.
Yeah. It's not only by 10 other banks, but on top of it, the money's sitting in one account.
Yeah. Very accessible. Yeah. Very liquid.
So.
Hey, just dug up some interesting information here before we go, that some SVB execs cashed out with questionable timing. Last gasp bonuses were dispersed, so there will be some fun scrutiny over this next week as well. Hey, Jim Cramer last month, anybody that follows Jim Cramer, said that SVB was a buy at 320. They halted the trading at 106. So it's kind of fun to try to wipe some egg off of Jim's face once in a while. Hey, that's going to do it for us here at Money on Tap. You can reach us at 855-226-8551 or info@yourmoneyontap.com. Appreciate all the subscribes out there in the podcast world, the likes, the listens, and just thank you. Thank you for being here with us at Money on Tap today. Be a successful investor, folks. Cannot wait to see you next week.
The views expressed are not necessarily the opinion of this radio station and should not be construed directly or indirectly as an offer to buy or sell any securities mentioned herein. Investing is subject to risks, including loss of principal invested. No strategy, product, material, or tool mentioned can assure a profit nor protect against loss. Please note that individual situations can vary. Therefore, the information, products, materials, or tools mentioned should be relied upon when coordinated with individual professional advice. Past performance is not a guarantee of future results. This show may be subsidized in whole or in part by a product sponsor or issuer. Securities and advisory services offered through SagePoint Financial Incorporated, member FINRA SIPC, and a registered investment advisor. All other services offered through Brayshaw Financial Group LLC are independent of SagePoint Financial. SagePoint Financial and Brayshaw Financial Group do not provide tax or legal advice. Main office is located at 116 South River Road, Bedford, New Hampshire, 03110, and can be reached at toll-free 855-226-8551.